This video focuses on a Japanese construction company, Nakano Corporation. Our discussion will unfold in three parts. First, the primary reason Nakano Corporation emerges as an attractive investment target. Second, an investment strategy inspired by Mr. Warren Buffett, borrowing Japanese yen at a low interest rate to purchase this stock. Lastly, Nakano Corporation's business and the construction industry it operates within. Welcome to Industry and Company. This channel explores investment opportunities through fundamental analysis. Nakano Corporation is listed on the Tokyo Stock Exchange under the ticker 1827. As of July 14, the stock is priced at 376 yen, putting its market cap at approximately 13 billion yen. Given the exchange rate of 140 yen to $1 at the time of this video, the company's market value hovers just under $100 million. This presents an enticing entry point for a small investment position. Please remember, while I present industry outlook and company fundamentals, the content should not be interpreted as professional financial advice. So, let's get started with our exploration of Nakano Corporation. First, why Nakano? The answer is simple. The net assets per share significantly exceed the share price. Net assets, also known as shareholders' equity, are essentially the company's assets minus its liabilities. This value truly belongs to the shareholders. Consider this graph, which compares Nakano against its peers in the Japanese construction industry. These numbers come directly from each company's reports, and Nakano's position stands out remarkably within its sector. Now, you might argue that assets are often overvalued, hence inflating the net asset value. If you're thinking along these lines, congratulations! You're advancing well in your investment understanding. Indeed, assets could include goodwill or trademarks that the company may not be able to sell at their book value. To delve deeper into the true value of net assets, let's scrutinize the balance sheet item by item. Don't worry if you're unfamiliar with balance sheets. I'll be explaining everything from scratch. However, if you're already comfortable with balance sheet concepts, feel free to skip ahead to the 3-minute 30-second mark. A balance sheet consists of three main components: assets, liabilities, and shareholders' equity. Assets represent everything of value that a company owns. This can encompass various items, such as the company's office building, furniture, computers, and inventory, along with cash in the bank and receivables, which is money owed to the company by its customers. On the other hand, liabilities reflect what the company owes to others. This can include business loans, outstanding payments to suppliers, wages due to employees, and taxes due to the government. These are financial obligations that the company is legally bound to fulfill. Shareholders' equity, also known as net assets, represents the residual value that would remain if the company were to sell all of its assets and settle all of its liabilities. In essence, it is what would be left for the company's owners, the shareholders, after discharging all debts. It is effectively the company's net worth. These three components of a balance sheet are interlinked by a basic accounting equation: assets equals liabilities plus shareholders' equity. Here is Nakano's fiscal year 2021 to 2022 balance sheet. Sorry, the latest 2022 to 2023 one was in Japanese only. The figures shown on your screen are in millions of yen. Assets are comprised of two parts: current assets and non-current assets. Current assets are those that a company expects to utilize or convert into cash within 1 year, including cash, accounts receivable, and inventory. On the flip side, non-current assets are those the company intends to hold for more than a year, such as buildings, machinery, and long-term investments. When assessing which parts of the assets can be confidently included, two major categories stand out. First, cash and deposits, which is typically the most reliable asset barring any financial fraud by the company. Second, notes receivable and accounts receivable, money owed to Nakano. This is usually considered reliable unless the debtor defaults. Notably, this item was smaller in 2022 than it was in 2011, a positive sign indicating that these notes are being repaid. Including only these two categories, current assets stand at 55 billion yen. Let's examine Nakano's non-current assets. Unlike American public companies, which by law must disclose extensive details in their annual reports or 10-K filings, Nakano has not revealed specific information about its buildings or land. Being cautious, let's apply a 50% discount to buildings and land minus depreciation. This amounts to around 8 billion yen. I would also consider the investment securities and net defined benefit asset, which are marked to market according to the notes. Hence, their value should be accurate. Summing up above, we arrive at a non-current assets value of 12 billion yen. Adding this to the 55 billion yen of current assets, we reach a total assets value of 67 billion yen. Remember, shareholders' equity equals assets minus liabilities. For a conservative estimate of shareholders' equity, we'll accept the reported liabilities of around 47 billion yen without any discount. By this calculation, shareholders' equity, 67 billion, 47 billion, equals about 20 billion yen. Given that Nakano's market value is around 13 billion yen, we can observe that, even under a conservative estimate, its net assets represent 154% of its market cap. If we further restrict our valuation to only the most liquid parts of Nakano's assets, current assets plus marketable securities, we have 55 billion plus 4 billion, totaling 59 billion yen. Subtracting the liabilities of 47 billion yen, we're left with shareholders' equity of around 12 billion yen. Impressively, this amount is almost as much as Nakano's market value. Don't forget, on top of the net assets, you're acquiring a construction business that generated 1.9 billion yen net income in the fiscal year 2022 to 2023. However, the market isn't entirely blind. There are reasons why Nakano's stock is inexpensive and might continue to be for some time. It's crucial to remember that Japanese firms like Nakano operate differently from their American counterparts. These companies often are family-controlled, long-term oriented, conservative, and not as motivated by shareholder interests according to the American model. This discrepancy can result in their share prices being undervalued by the capital market. Another factor that particularly pertains to Nakano is its small market cap. Its limited size and low trading volume don't capture the interest of institutional investors. You might ask why that matters to us. The answer is when institutional investors hold board positions, they usually advocate for policies that favor all investors, including minor shareholders. Suppose I'm an institutional shareholder and have acquired a significant stake in Nakano. In that case, I would urge the management to borrow yen and use the surplus cash to enhance dividends or initiate stock buybacks. These are the typical strategies that activist investors use to unlock value for shareholders. Any of these moves could instantly drive up the share price. Regrettably, we don't foresee such a catalyst emerging in Nakano anytime soon. Therefore, despite its current price seeming like a bargain, I would advise only a small position on it. The next point of discussion is the strategy to borrow Japanese yen to invest in Nakano. In my brokerage account, I have the ability to purchase the stock on the Tokyo Stock Exchange with a negative yen balance. This essentially means that I'm buying the stock using borrowed yen, on which I'll have to pay an annual interest rate of 1.5%. However, Nakano provides a 3.5% annual dividend, so there's a net positive income even while waiting. In addition, Nakano is projected to earn 2 billion yen in the fiscal year 2023 to 2024, which translates 14.5% earnings yield. This strategy is reminiscent of Warren Buffett's tactic of leveraging the low interest rates on the yen to invest in Japan. Just ensure your brokerage charges a reasonable rate for borrowing yen. Naturally, the rate Buffett obtains is lower, more long-term, and less susceptible to decisions by the Bank of Japan to increase interest rates. Another option is to exchange US dollars for yen and then buy the stock. In this case, your Nakano position in US dollars would fluctuate based on the exchange rate. Personally, I prefer to earn over 4% interest on my US dollars and remain neutral on exchange rate. Finally, let's talk about Nakano as a business and the overall construction industry. Nakano specializes in building large-scale structures, including apartments, hotels, factories, and public facilities. Its operations extend beyond Japan into Southeast Asia. The proportion of revenue from outside Japan accounted for 25.6%, 19.8%, and 34.9% in the fiscal years 2022, 2023, and 2024, respectively. The construction industry is cyclical. with its activity levels rising and falling in response to the overall state of the economy. Here are a few key factors. Economic expansion and contraction. When the economy is growing, demand usually increases for new construction projects, both residential and commercial. In contrast, during economic downturns, the construction industry is often one of the first to feel the impact as businesses and individuals reduce their spending. Interest rates. Construction, particularly in the real estate sector, heavily depends on interest rates. Lower interest rates make borrowing cheaper, which incentivizes individuals and businesses to undertake new construction projects or purchase new properties. Conversely, higher interest rates can dissuade new construction due to the increased cost of borrowing. Government spending and consumer confidence are other factors that tend to fluctuate with the overall economy. The provided graph shows Meccano's net income per share from 2006 to 2023. Its volatility is evident, as it turned negative in both 2012 and 2022. The fiscal loss in 2011 to 2022 was due to cost inflation after contracts had already been signed. Looking at the operating margin over the years, which is the ratio of operating income to sales, it hovers below 5%. Even Kojima Group, a Japanese construction company 70 times larger than Nakano, couldn't do much better. This contrasts starkly with industries like tobacco, which I discussed in my last video, where operating margins can easily exceed 30%. Due to such low operating margins, a company can quickly transition to losses if the macroeconomy worsens. This is precisely why the construction industry is not one of my favorites. However, the strikingly undervalued state of Nakano is compelling enough to make me change my mind this time. Another, albeit slower, catalyst for an increase in Nakano's share price could be its business expansion in Southeast Asia. As the U.S. gradually distances itself from China, it's inevitable that more companies and manufacturers will migrate to Southeast Asia, with prime destinations aligning with Nakano's markets: Thailand, Malaysia, Vietnam, Indonesia, and Singapore. This shift will stimulate the demand for construction. Turning to Nakano's risks, the Bank of Japan is anticipated to revise its negative interest rate policy. As discussed earlier, this could impact the construction industry negatively. However, if interest rates rise, Nakano's positive cash balance would generate interest income, which offset the adverse effects. The second risk relates to corporate governance due to Nakano's small size. This doesn't imply that I detected any issues, but rather it's a point of uncertainty. I generally apply a discount to situations I'm less confident about. For instance, Nakano is audited by a Japanese accounting firm, not one of the Big Four. It's unclear whether it holds any off-the-balance sheet debt unknown to outsiders. The third risk is the potential resistance to unlocking value due to traditional Japanese business practices. Japan has a long-standing system of cross-shareholding, or keiretsu, where companies and banks hold shares in each other, creating intricate networks of interconnected ownership. This system serves to stabilize the share ownership base, facilitate long-term business relationships, and protect companies from hostile takeovers. Despite the Oshima family only controlling 30% of the shares, they might collaborate with other shareholders, making it difficult for activists to implement radical management changes aimed at returning more value to shareholders. Even with extensive due diligence, I still can't guarantee I haven't missed something important about Nakano. Investing isn't like chess, where you have access to all the information and could, theoretically, calculate every possible move. Rather, it resembles a game of poker, where decisions are based on incomplete information. You reason with logic, speculate with insight, and act upon probability. While every round might not be a victory, a mathematically sound strategy over the long term promises rewarding returns. Thank you for watching Industry & Company. See you next time.